multifamily class today, guys. We'll try and make it short and sweet, and I like to make it kind of an open conversation. So I have a PowerPoint, it's got some basics in it, we'll kind of run through it, but then we'll kind of get off the PowerPoint and we'll just talk, go through stuff, especially if you've got anything that you're working on right now. Happy to run through it with you, put another set of eyes on it and let you know what we see. Has anyone here done any multifamily deals?
Low key, as I was telling Carol, in California, low key, I mean, less than 10 units, as well as like a 4-unit commercial in a redevelopment zone in California. But yeah, which just gives me more questions. I actually have like 6 questions for you.
Awesome.
Just based on wanting to know, what the hell.
Perfect. I love questions. That'll definitely come into play. So that's great. What's your name?
Andrew.
Andrew. Pleasure to meet you. Anyone else? Perfect.
There.
Yeah, you've had a couple that have crossed your path. So.
Some syndications too.
Hey, nice. Has that been going more lately? Have you seen more
More
of
than
it?
investor.
Gotcha.
Those are easy. Wire money.
Yep. Here you go. Done deal. So yeah, questions, comments, concerns, even if you want to share some fond childhood memories, whatever. We're in open conversation here. So we'll run through it. We'll tell you all the good stuff. The fun thing about commercial, at least in my opinion, is it's less emotional. It's just kind of down to business, down to brass tacks. It works or it doesn't. Every now and again, we'll get some guys with some egos that have to one up each other, but it's rare for the most part. And of course, the thing with most agents in commercial, especially the ones that give me a call and say, "Hey, I've got this deal or I got this stuff," is of course everyone always is looking for those big dollar figures. They're going, "Hey, we've got big stuff coming in. We're going to make some money," and now my computer's like completely shut down. Come on, where are we? Maybe we have to do this by hand. Anyway, yeah, bad transition. You want to make money. That's what we're looking to do. So, who is this guy that's going to talk to me about commercial and making money? Give you a brief introduction. I'm an Arizona native. I have born and raised here. I am actually 5th generation Arizonan. One of my great grandfathers was one of the first pioneers to come into northern Arizona. So, good old cowboy heritage stock there. I love Batman. I think he's the greatest superhero because his superpower. Anyone remember that quote? Batman, you're so great. What's your superpower? I'm rich. So anyone can be rich. So he's obtainable. We can be Batman. I started my real estate career in 2000, right at the verge of Y2K. The world was coming to an end. Computers are going to shut down. Roads are going to cease to exist. There's going to be mass chaos. We were all prepping for it, and nothing happened. It was fantastic. Everything moved right along. But I got my real estate license in a matter of a couple weeks. I was actually in school. I was studying to be an engineer, and I was in an internship. It wasn't going that great. I didn't like it. Realized that I don't want to be an engineer, so I dropped out of school. A buddy of mine had started a real estate company. Said, "Come lease houses." I was like, "People lease houses? The craziest thing I've ever heard." I had no idea. I'm 19 years old. Lease houses. Why are we leasing houses? Anyway, I spent the whole weekend at Walden Books in Fiesta Mall. That tells you again how old I am right there. Walden Books isn't around. Fiesta Mall isn't around. Reading everything I could on real estate and how it worked, and I thought, man, I can have my own schedule, I can do my own thing, and I can make money. This is great, all this wealth in real estate. So I jumped into real estate. We started out as a property management firm. We quickly advanced into an investment firm. And so everything we did was investments, which was great because I cut my teeth understanding cap rates and ROIs and internal rate of returns and what's our debt service coverage on this property and having to do sheets for investors that laid out the best and worst case scenarios of everything. That naturally evolved with people going, "Hey, I've got 4, 5, 6, 8, 10 houses. I need to roll it, I need to move it. What are we gonna put it in? Oh, let's put it into an apartment building. That sounds great. Let's put it into an office building. Let's put it into something that's commercial, a little more hands-off. Now that you've got this capital that you can get past that barrier of entry with the heavy down payment, we can get you into it. So the first commercial building I did was that building right there in 2004. And as soon as I did that, I was like, this is awesome. This is the best thing. It was so simple. The paperwork was magically low, which is another reason I love commercial. We just had another agent. I partner with agents all the time that aren't on my team or anything that just need help getting through a deal. And he was on the Loughton team, and he was doing a deal, and he's like, hey, my TC wants, we need this, this, and this. It's like, doesn't apply for our deal. But no, they say you need this, 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 and this, and we gotta get this file, and this. I was like, no, you need the agency agreement and the purchase contract. Your file's done. What? Are you kidding me? No, that's all you need. We're going to get it closed. You're going to be fine. And you don't need the other 12,000 forms that they have for residential. So my heart goes out to you guys every time I look at that checklist, because I'm like, oh my gosh. If I had to get all these on one deal, I would probably get fired because I wouldn't get it in. And they'd be like, Aaron, you're getting severed because you never turn your paperwork in. So anyhow, backtracking this, I loved it. I was like, man, commercial's awesome. And since then, I've done just about every type of real estate you can imagine. We did all the residential stuff. We did all the commercial stuff, office, industrial, land, development, land leases, you name it, I've been through it. I've only been stumped once, and it was like 3 years ago by Shane Cook. I don't know if anyone here knows Shane Cook. Great guy, but he always finds like the crazy, cool, weird deals. And he's like, hey, have you done one of these? Yeah, I have. I'll help you through it. Hey, have you done one of these? Yeah, I have. And then he brought me one. It was like a federally insured land lease with something. So I was like, and a development. I was like, I have never done one of these, dude. You get the gold ribbon. So let's dig into it and see if we can figure it out. Howdy. So yeah, I've been through it all. Even when the crash happened, the Great Recession. If you guys remember, commercial was dead. We couldn't give space away. We couldn't sell space away. We were selling stuff at 11, 12, 13, 14, 15% caps.
Wow.
Just to get someone to take the risk and take it down. Like, it was horrible. So we flipped houses. So I went back and did more residential stuff during about a 3-year period. We flipped, dang near close to 300 houses. And so I've seen both sides of the tracks in some regard. So it helps with having experience on just about every level of where we've been. I am married to my beautiful bride. We have 5 crazy kids, and I definitely see this slide. My oldest is now, man, this slide's like 2 years old. Which one of these is the laser pointer? I'll mess this up. Anyway, my oldest there on the left, he's actually a Marine now. He's stationed in North Carolina. So, that's a little more updated. Man, I gotta update these slides. We are crazy. It is a shit show 24/7. I was just talking to my wife on the way here, and she's like lamenting. I'm like, I know, you're awesome. Keep it up. I don't blame you. They're freaking crazy. I love jackets.
Nice.
I love crazy jackets. I've got, I don't know, dang near 40 of them at this point. And so if you see me at the Christmas party, I'll probably be in that jacket. That's my favorite Christmas jacket. And I only get to wear it for like 2 weeks a year.
Sure.
So I cash in every year. And I, since coming to my home group, I've only been at my home group now about 3 years. I think we're coming up on year 4 here shortly. But I've been in the top agents every year. That year was a particularly good one. Out of, I think we only had about 2,200 agents at the time. I finished second in the entire brokerage.
Wow.
So maybe it was third. It was second or third. I don't remember. But it was in there. So, moral of the story, trying to say, I got some knowledge, as my wife would say, a lifetime of knowledge. And we're going to share it with you today. But a fair warning, I do have a disease. And so I put this out to everyone. It's called Wetzel Such. My wife calls it Wetzel Dutch. that makes me say puns, sexual comments, and dirty jokes and pointless stories at inappropriate times, and they have no purpose for anything but except to make me happy. So I apologize in advance if there's anything crude or lewd. Take it up with my wife; she'll feel your pain. So first thing we're going to talk about with multifamily. And I like to start here because I think this gives us the basis for just about everything you're going to see, everything you're going to do as you go down the road with multifamily. And that's caps and NOIs. Is anyone familiar with those terms? They're pretty basic. We hear about them a lot. I personally, investors call me like, I need a 6 cap, I need a 7 cap, I need an 8 cap. And I always backtrack them. I say, okay, let's pause for a second. When you say a 6 cap, what are you looking for? Because everyone's definition of cap, it should be simple, it should be basic. The math's here, we'll go over it in a second. It should all be the same. Unfortunately, it's just not, because it depends on how people are getting to that cap rate. So I like to focus on the NOI first. So everyone always comes to me and says, oh, the cap, the cap, the cap. And the guys in my office, they know they're going to bring me something and be like, hey, this one's a 7.8 cap. What's my NOI? Let's get there first. Because the NOI is going to change depending on how you look at it. So this is a fun slide with a ton of information on it, but it gives you an example of looking at an apartment building or a multifamily plex. And let me clarify, when we say multifamily, we're saying anything over 5 units. So 4 units and down, residential, you can even purchase that as a primary residence and rent out the other 3 units. That all falls under residential. As soon as you hit that 5 unit, even if that unit is a closet, it's got 300 square feet studio attached to 4 units that are 2,000 square feet apiece, you've now changed the definition, and that's where everyone, the government, loans, HUD, everything is, okay, now we're into multifamily, now we're into a commercial deal. So this one, for example, is a 24 unit apartment. Good little size, great for what we're seeing out there in the market right now. Give you a good example here. So let's say the units are only getting $525 a month, which that is not the case because they're getting a lot more than that now. But that gives you about $10,200 a month. So you do that with your multiplier, you're getting $122,400 a year. Now what you're going to take out is your vacancy and your rent loss. Now, everyone's vacancy gets calculated different. So this is what I mean. This is where your variables start kicking in right off the bat. If we were doing it just on our gross, bam, we got our NOI, we know what we're dealing with. But everyone's going to look at the vacancy rate different. Right now, most everyone's pushing, saying, oh, we're only at 5% vacancy, we're at 3% vacancy. That's a hard BS. Like, it's just not. In a perfect world, yeah, but we're not there. 10 is a pretty decent percentage. 10% is a pretty decent percentage to be conservative, to help yourself, unless it really is a property that's going to be an add value property. Has anyone heard that term lately? It seems to be like every year there's a new flavor of terms that people are going like, oh, I need something like this, I need something like this. In the last year and a half, it's been add value, add value, add value, which is basically meaning I'm going to get a property that's not performing that great. Maybe the rents are low, maybe it's got high vacancy, maybe it's outdated. And I'm going to come to it, I'm going to fix it up, I'm going to kick out some riffraff, I'm going to put in some good tenants, I'm going to raise the rents. Now I've added value. They're basically flipping an apartment building in a lot of terms, in a way to convert that to residential. So looking at it, you're going to look at your vacancy rate. 9 times out of 10 when you're getting stuff from the other side, from the broker, they're going to say it's 5 to 3%. And quite honestly, if I'm listing something, I'm going to do the research on it, I'm going to pull it, I'm going to say whatever the actual vacancy rate is for that building. But most are generalizing it off of the sub-market. So a sub-market would be, we're listing a property and it's in off Rio Salado and right by ASU. Sub-market of that's going to be North Tempe. We're not going to pull stuff from South Tempe. We're not going to pull stuff from Mesa. We're going to pull the Tempe submarket, North Tempe submarket. That's going to pull in some of South Scottsdale. and we're going to do the vacancy rate as a whole. And that's what a lot of stuff that you're going to see out on the marketplace is going to do. They're going to pull a sub-market vacancy rather than dial in on a specific property vacancy. What I always say is, give me the property vacancy. I want to know exactly what it's done. And you got to look at it over time, right? Whatever it's done in the last 6 months might not be what it's done on average over the last 3 years. So get
You
those.
said the last six months?
Yeah, so 6 months, sometimes they'll say, oh, we're at 100% occupancy. We've been there for 6 months. Well, great. What were you before that? Oh, we were 50% vacant. Okay, well, what did you do? Did you give massive incentives to get people in? Did you update the property? Did you give away free rent? Hell, did you give away a free car? I don't know, but let's,
No, I'm just thinking, I thought 6 months versus say a year, because, I don't know, it just seemed to me that a year would be more telling.
Yeah, and that's what I'm saying. Yeah, we don't want a 6 month. I want like a 3 year.
I completely misunderstood you. Thank you.
Yeah, thanks for clarifying that. And I could definitely misspeak on some stuff. So yeah, call me out if stuff doesn't come through clear. Yeah, the more you can get on that, the better. And I say there is a point of diminishing returns because the market we're in today isn't the same market we were in 5 years ago. But 3 is a pretty good, average of where things are. 1 year is hard in commercial because there's so many variables that happen in a year, especially like last year with COVID, the election, everything that went on. Almost all of my investors are saying, don't even show me the last year. Kick 2020 completely out. Give me 19, give me 18, maybe 17, and let's kind of go back to a generalized nature of what the asset was performing at. So that's your vacancy rate. Then you're going to take in your miscellaneous incomes. When you get into some of these that are around your 20 units and a little bit more, they'll have on-site amenities that are maybe adding rent income. You might have a laundromat, you might have a concession stand, or vending machines, thank you. So there could be all sorts of stuff. And anymore, especially if you get into the newer stuff or stuff that has had the add value done to it. And we were just looking at one that was like 65 units. And they had like dry cleaning drop off. They had like a bike repair. They had the on-site laundry. They had all sorts. I was like, this is crazy. Like, yeah, you go to the Optima, you're going to get that. You get 65 units off of Roosevelt Row. Like, this is a totally different story. But they're putting in more and more amenities all the time. And so we're kind of seeing that as a trend as well, that a lot of the multifamily, especially as you start getting into the 100, 200, 300 units, they're really getting the amenities packed in there. So you put in your extra income, then you start subtracting your expenses. And this is again where it can get a little bit variable based on how people are counting them. We just did a deal where the sellers had owned the property for dang near 25 years. They built it, they owned it, they managed it, so it was self-managed, and it was run mom and pop. Like when we ask for the financials, normally people will, they'll download their QuickBooks and they'll send us the stuff over and we start digging through it. No, they came to our office with a crate and said, here's the bills for the last year, and here's our rent roll, and it was like literally on a ledger. Like I hadn't seen a ledger in like 20 years. It was like written out and who had paid and like check. Like it was like the fold out ledger. I was like, oh my gosh. So I mean, we definitely earned our commission on that one because my poor partner Nick, like he just went through these things. And there were stacks of bills on tables forever. We're like, oh, grab those bills. We gotta go through those and make sure those were right. So we basically had to rebuild everything for him because there was no electronic copy of anything. Most anything that is out there, you're going to get a Dropbox. They're going to send you the rent roll. They're going to send you the expenses. But then we're going to dig through that expenses and see what's in there. So, for instance, like on this mom and pop one, what does everyone do in a small business? They're putting their private stuff in there, right? The classic ones we see are, hey, this is my automobile costs, these are my gas charges, oh, the utilities for my house happen to be getting paid by the So you got to take all that stuff out. Most of the time when you're getting into anything in the larger units, even past 20, 9 times out of 10 they have a property manager, 9 times out of 10 they're being managed correctly, you don't have to pull the slough off. Always check it though, because you just never know. We had another one where It was attached to the city sewer, so we knew it was on sewer. We verified that. We'd already had a property inspection. They'd scoped the sewer lines. Everything was good. But then in the bills, in the expenses, we're seeing these charges from a septic company for pumps and repairs and all this stuff. We're like, why are there all these expenses? You know, like $12,000 a year in expenses for, like, this property can't be on septic. And it was like 3 separate buildings. We're like, there's no way it's on septic. We're racking our heads together. We're going through it. We finally call the other side and we're like, okay, we've pretty well verified that these bills are accurate. We've verified that this thing's on sewer. Why do we have septic charges? And like, oh, well, it's a septic company. What it is, though, is that we have, I can't remember the term. It's basically the property is like 2 feet below the road level. So they were fine. They didn't have any flooding. They had on-site retention and all that stuff. They never had any flooding issues. But because they were 2 feet below the road level, the sewer line that they had to connect to had to travel uphill. So all the sewer was collected, churned, and shot uphill to hit the city sewer. We're like, well, damn, we would have never known that before. It wasn't anywhere in the paperwork. It wasn't anywhere in the OM. It wasn't anything we had seen, but it was in the expenses. So, I mean, and it still had the same cap. They had accounted for the expenses. So it didn't change our numbers, but now it changed our variable of just, well, now we got to deal with this. Is this something we want to take on? They had replaced a bunch of stuff. It was all pretty much brand new. A lot of it was under like 5-year warranty. So we're like, all right, we'll take it on. Obviously, they've been doing it for a long time, and it seemed to have worked, so we'll run with it. But it was a variable. We would have found out no other way than going through the expenses. Some of the other ones you can look at that can shift your numbers is like legal and administrative fees. You know, sometimes they could be pounding those through when they really don't need them. They'll have all sorts of these expenses in there, so you got to dig through it and see what changes. And vice versa, sometimes you'll get an expense sheet, you're like, man, this thing's running lean and tight, this is great. And then you're like, I know that they've had some maintenance on the property, why don't I see any maintenance bills? And they're like, oh, well, we didn't include any of the maintenance because that's all CapEx. And we're like, but let's see those bills and let's really determine if it's CapEx. And the next thing you know, you got a landscaping bill, you've got someone that painted, and you've got someone that, you know, repaired a door, and then maybe a roof. You're like, okay, the roof and the paint we'll put as CapEx. But we've got, you know, maintenance that's monthly for landscaping, that's an expense. We've got to shift that out of our CapEx category. We're going to move that to our expense category, and that's going to change our numbers. Or like the one I mentioned earlier, something that's self-managed doesn't have a management fee. But now you're going to go get a property manager most likely, and that's going to shift your numbers at least 5%. So looking through those expenses will, again, change your NOI, but is also why I say it's variable, because it's everyone's opinion of what should be in there and what shouldn't. So you really want to go through those with a fine-tooth comb. That'll get you to your last part, which is your utilities, advertising, lawn care, pest control, all that basic monthly expenses. Those are all things that should be in there. Utilities, for sure. One of the things that you'll see on some of these older properties, like that one I mentioned that was the ad value, some of the older ones, they didn't separately meter a lot of the property. It's pretty common that you'll find one water meter, and then you'll find all the electric metered separately. This one had one water meter, one electric meter, so they hadn't separated anything. So then you'll get into a position where you have rubs. Has anyone heard that term before? So they'll say, oh, there's rubs on this property. Well, rubs is basically a ratio utility bill. So they're basically saying, okay, we have 26 units, and you can have it as simple as there's 26 units, the electric bill was $2,600, everyone's getting charged $100 this month, and they just break it out, here's your rubs, and they'll put it on the invoice. I've seen some really creative ones where it's based on the square footage of their unit, it's based on the age of the AC unit that they happen to have on that unit, because sometimes they'll get replaced at separate times, the number of occupants in that unit, and the average hours that they occupy their units. So some of them can get like really deep and intense, and it's like, hey, here's what we're monitoring, here's what we do, and here's how we calculate our rubs. Some of them are as simple as, oh, the bill was $3,000, and we split it equally amongst our 30 tenants. Everyone got charged about $100. So be aware of that if you're looking at the rubs. But that's also a really great way to add value on a property. We did that with a smaller one in Arcadia. It was only 16 units, and they had one water meter, one electric meter, and they were not doing any rubs. So they just were saying, hey, here's the rent. And they kind of had an inflated rent. 1, it was in Arcadia. 2, it had been remodeled. 3, they knew they were covering the electric. What we were able to do is we started dissecting the property. We were able to look at the electric bills for the last couple years, determine how it had been running, how it was looking. Most of the units had been replaced at this time, so we knew that kind of shifted in our favor as well. And then we looked at the rents. The rents were actually, great and would probably continue to go up. So we said, hey, we're going to keep the rents the same, but we're going to institute rubs. And his was kind of a middle of the road, like number of occupants, size of square footage of your unit, and then this is what we're gonna charge you on your rubs. And it was a great way to add value to the property on something that wasn't being collected. We kept the rents the same for the first year, instituted the rubs, and then the next year, as things continue to progress, you continue to increase the rental rate. So you can look for that as an opportunity if it's not there, as a way to increase the value of the property.
It would be cost prohibitive to put in 16
meters.
Meters.
Yeah, I mean, generally speaking, depending on how it's ran and where it's coming in from, I mean, you're talking anywhere from $5 to $10 grand a unit on the low end. So so if you got 24 units, all of a sudden you're dropping $240,000 to bill your electric, and it's like, does it make sense? No, let's just keep it going and we'll do the rubs. And usually your property managers will do it and they'll manage it. And it is considered additional rent, so they can be evicted for it if they don't pay it. But the property managers usually charge a service fee for that. Sometimes the property managers will even charge that to the tenant and say, hey, we're managing this and we're going to keep it good for you, but we're getting paid $15 a month to do your invoicing. So some landlords will pass that on to the tenant as well. So of course it's got to play with what your rents are. You can't price yourself out of the market where people go, oh, you don't want to go to that building. They rob and steal and take all your money. Then you got a bad stigma. And then tenants talk to tenants, and people in the same area talk to people, and next thing you know, you've got a massive vacancy. So you got to kind of handle it with kid gloves, but it's definitely doable. So last but not least, you'll take all those figures together. You'll get down to kind of what your net operating income is. That's your NOI. And you'll use that from here on out to calculate your cap. Now the other thing that all depends on who's calculating it, who they're putting in there, is your debt service or your mortgage. A lot of NOIs that you're going to see on the market when someone sends you a brochure or a flyer is not going to include the debt service. So you'll look at your cap and you'll say, oh, it's 6% and it looks great and I've got this NOI that's strong, but there's no debt service in there, which is fine if your client's buying it cash. If it's not, now you're going to have to look at what the debt's going to be, what that mortgage is going to be, and how that's going to affect your cash flow as well. So that can vary, of course, depending on property to property. So after your NOI, then you get to your cap. So you'll take your cap rate and you'll take your NOI, you'll divide it by the purchase price, and that's your cap rate. So super simple math after that. Once you've gone through all the expenses and everything, you get what the NOI is, you will just divide that NOI by the purchase price, and that'll tell you your cap. And it's always good to double check it. We have plenty of spreadsheets on Excel that we just start plugging stuff into. We basically rebuild every deal we get just to make sure that the math adds up. And then you can also do it just the opposite way if it's unpriced. We see that being trendy as well. We'll see a lot of stuff that just goes out on the market, or that we get emailed from other brokers. They'll be like, hey, we have this great complex, we have this really good unit. Here it is. Take a look at it. Tell us what you think, and we'll be like, oh, great, that's awesome. What's the price? Market price. Awesome. Thank you for the guidance on that. Or they'll be like, it's unpriced. Now, a lot of times you can look through the OM and kind of see what comps they've used, and that'll tell you where it's at. We had one just yesterday. We were in the office, and Nick sent it over to me. I was like, man, this one looks pretty solid. What do you think the price is going to be? He's like, it's probably going to be like 10.5. I was like, oh, okay. Did you do that on based on the expenses? He's like, nah, I just looked at their comps. It's like their comps are all between 10 and 12, so it should be at the lower end. I'm going 10.5. So then I was like, oh, call the broker, see if it's still available, see what he's thinking, see if they have a whisper price, which I hate that term, it drives me crazy. And so he called the broker, he's like, hey, what's your whisper price on this one? He's like, we're trying to go, if we landed at 11.5, we'd be done. So it was unpriced, but we were able to, look at their comps, look at their thing, know what they were kind of thinking on it, and then Nick was pretty close, 10.5. And that would probably be where, if we go to offer on it, where we would go in at, because looking at the original numbers, that's where, or initial numbers, that's probably where it should land. Of course, they have a little bit more blue sky. They want that 11.5 to make it a little bit bigger. But you can go backwards on that to find your cap. So let's say they don't have a cap rate, or they don't have it priced, and you're trying to figure out the cap the other way. So you can take the NOI that you've got on the form, and you can say, hey, I want to get a 9 cap, or I want to get an 8 cap, or I want to get a 7 cap. And you just divide that NOI by the cap rate you want, and I'll tell you your purchase price. And we've done that before on a number of deals too, where we're working with investors. We had an industrial deal in Tucson that was a fairly good sized deal, and it was unpriced, and they would not give us any guidance on where they wanted to land at all.
Good question, because it would greatly affect us, and it comes out of all those years seeing, yes, the 1 to 4 units with these fictitious numbers and those 3% vacancy rates. Yeah, but you had one empty all year. That's a 25% rate there, pal.
Yeah.
But getting to the rents, nobody ever took any action on escalations. Well, this is below market rents, but we're going to do the cap rate on based on market rents. Do you ever see that? How do you handle that? I'm supposing the larger the property, the less that occurs. But what happens when the leases had escalations in them, and because it was mom and pop, never did anything, or for whatever reason, bad management, they are below market. You might have 100% occupancy, but you're losing money. How do you value that?
Perfect. Yeah, some good questions. So I'll kind of try and tackle all that in here. We see it all the time. And it still catches me to this day. I've been playing this game for 20 years, and it still catches me. Just last week I had one, actually not, I even had one today. I was on the phone with an investor before I came here. We were looking at a retail shop, and I sent him a bunch. I sent him like 8 different properties that kind of fed his mold, and I was looking at them all, and we're going through them together, and he's getting my feedback and getting his, because we're trying to hone in on what he wants. And we're going through it, and I was like, no, this one's sitting at 7.18, it looks good. And then I scrolled to the next page and I started looking at it. One of their units is completely vacant, and they had filled it in as performing, and this is what it should do. And so now we've got a performa cap. And I hate that. It drives me crazy, because I don't want to know what it could do. I want to know what it's doing right now. And so what they're selling us on is that blue sky of saying, well, here's what it could do. And my argument always back to the broker is, well, if it could do that, why is it not doing that right now? And usually it's one of those. It's bad management, like the one I was telling you about earlier with our creative bills. They had escalations in their lease. They just never did them. They downloaded a lease off of the internet, 20 years ago, 15 years ago, and started using it. And then we're like, well, where's your escalations? Well, what's that? Well, that's where your rent increases. Well, we just signed a new lease, or they move out, we put someone else in. And it's like, oh my gosh, guys, no, like you're not performing. But flip side, I'm the listing agent on that. I disclose it up front. Here's where we're at right now. This is not performing, but there's a lot of add value in this property because here's what's not happening. For me, I take that negative and turn it into a sales point with the other side, right? Like, we're performing great now. You're getting a great cap walking into it. We're not trying to sell you on some inflated cap. And two, you've got easy, low-hanging fruit to increase income instantly. You start making the lease. It's already in the leases, so all you got to do is enforce it. So you can send everyone a notice from day one and say, hey, your lease is now, your rent is now this because that's what your lease says. And then all the other little, things that they weren't doing because they're just mom and pop managers. So yeah, we see it, unfortunately, probably in about 40 to 50% of the stuff that crosses our table ends up being a pro forma. We can, backtrack it and reverse engineer it and go, okay, here's what it is. Does it still make sense? And sometimes they do. And then we'll do our own analysis of it to see if their pro forma rates are accurate. And if they are, then we kind of know what our delta is and what we can push for on the property, which is also helpful. We're looking at one in downtown Phoenix right now, just popped up on the market this week. And same story, super low rents. They haven't done a whole lot to it. So my instant, and the cap's horrible going into it. It's only like a 4.25. Sucks, right? I don't want to sit on something with a 4.25. But then we start doing the math of what is the rate, where should the rents be, and without dumping a whole lot of money into it, because they're fairly decent units, but what can we do just instantly, just raising the rents because it's under market? And it already pushed it up over 6. So it's like, okay, now we've got a property we can look at. Yeah, on first glance at the 4%, this sucks. We're not going to touch it. But now we're at 6, and we can do that right away. Then we can do, as one unit moves out, we'll remodel it and put a higher rent on that one, and so on and so forth. It's also got some space where you can build another unit. So you start looking at all that stuff for the long-term value add, but initially, the cap wasn't great, but we'll get it there. And then the pro forma, always look for the pro forma. This one was frustrating this morning because nowhere did it say pro forma. Generally speaking, brokers are pretty good and they'll say pro forma, above their numbers of here's what it should do. But this one didn't even say it. They just took the rent roll and literally filled it in, and then over where the tenant's name was, where you just, your eyes don't look for the names, they're just
Right.
looking for the gaps. There was no gap because they're like, future tenant. And I was like, well, yeah, someday, maybe. Like, I don't know.
Nice try.
Yeah, nice try. I'm glad this, tenant's name is future tenant. I didn't know we were getting a celebrity in here. So yeah, did that answer all your questions on that?
Thank you.
So the misnomer that also comes up is the higher the cap, the better the property, right? No, not always. You've got your degree of risk on our horizontal, we've got our cap rates on our vertical, and as people look at this, they're like, no, as the cap goes up, your property is better and better, and it's just not. Whatever that cap increases to, your degree of risk increases as well. And so, for instance, like right now in the current marketplace, if I see something at an 8 or a 9 cap, my initial reaction is, okay, where is it? Because something's off. Because no one's giving anything at an 8 or 9 cap right now. We took that one I was telling you to market like right under 8, like 7.9, but that's because we knew it wasn't performing well. They weren't doing the leases. It was mom and pop. It had all these problems, right? So we knew that we could get there. The crazy thing is as we actually started going through the deal and finding out more and more as the deal came together, it actually ended up trading at like a 9.5. I mean, the guys scored huge. We didn't feel bad because we felt we did great for our clients. No one else could have sold it for them because it was just such a shit show. And they were happy. They were all ready to retire. They were tickled pink. Because they initially thought they were only going to get like $3 million for it, and we got 3.75. So they were totally stoked. But it was a higher risk because it had all those problems. So there was another one. It was an office building, and it looked beautiful in pictures. I mean, high end, beautiful, great, and they were trading it at like a 7.88, I think. And my team sent it over to me. I was like, oh, hold the presses. This one's great. I think we could sell this tomorrow. Like, okay, so what's wrong with it? So, I mean, we're all, office, this nice, class A, this thing should be trading like 6. Why are we so high? We're pushing 8. And so they're looking at it like, no, we got long-term leases. We didn't have any accredited tenants, but we didn't have any like bad tenants, if you would say. So it was like, more mom and pop, but they had long-term leases. I'm like, this doesn't add up. I was like, okay, pull it up on the map. Like, what's going on? I knew it was in downtown Phoenix. Well, right next door is a strip club. I mean, like literally next door. And the building, the office complex, because most office complexes have a name. This is Forum North. This is the Arrowhead Center. This is, Gilbert Embankments, whatever. This one was called The Strip. And I was like, oh, jeez. Like, just the stigma alone, I can't sell it to any of my investors. They're just not going to take it.
Larry Flint.
Right? Gotta find the right investor. Well, that's the thing. Like, there's always every year there's 1 or 2 strip clubs that come on the market. And to give you an idea of high risk, they're always trading at there was one last year, right at the end of the year, like November, December, came on the market. And one of my guys was like, hey, we got another strip club. I was like, awesome. I'm going to take a guess on the cap rates, 12. He's like, no, 11.4. Like, so it gives you an idea, right? Higher the cap, higher the risk. And it's just because 9 times out of 10, they're volatile. They're not kept up well. There's a ton of deferred maintenance. And, is your tenant going to be there next month? You just don't know.
For those strip clubs, are those like triple net investments, or is it?
Yeah, they're triple net, which is great. For the right investor, every deal works, right? For the right guy. We took on these 5 horrible properties. I literally did not want the listings. Like I told it was an agent that I've done a ton of work with for like 15 years. He refers me all this commercial. And he was like, Aaron, I need you to take these for me. I was like, dude, I don't want them. He's like, don't even pay me a referral. It's my client. I've had her forever. I need you to take care of her. It's like, I don't want the phone calls. Like, please, just take these listings. I'm like, son of a bitch. Okay, I'll do it just because it's you and I want to keep the relationship. Anyway, we took on these 5 horrible listings. Her husband was the family started carnivals, of all things. Made a fortune in carnivals, sold off the carnival, made a ton of money, and then he invested the money in like heavy equipment. I mean, this is like starting in like the 30s, right? The 30s and 40s, like they're much older. And by the time he created this awesome, amazing heavy equipment company and sold, multi-million-dollar machines, and then he sold that. Anyway, the guy was sitting on like $400 million. And so he was bored, and he would just buy properties on internet auctions. And he would just buy these things, and so he had like these 30 properties throughout the United States that were just random shitholes. Like, there's no better way to say it. Like, you would pull up to them and they were just homeless encampments and they looked like someone shot a Saw movie inside of them. Like, it was not good. You're like, dude, I am getting my gun to walk through the rest of this property. This is not good. So we take on these listings. Literally, we have sold all but one. And I'm like, how is this even possible? I have a Class A building up on 19 and Union Hills. I can't get it sold for the life of me. And these things that look like someone shot a horror movie in them are off the market, and people are buying them up. I mean, we priced them right. We didn't give them away. We wanted to give them away, but they're also super stubborn clients. And they're like, no, I want to get this return. Nothing based on comps. Like, we send them all the comps. I don't care what the comps say. This is the return I want. Sure as shit, you got the return you want. And I'm like, dude, you blow my mind. So, yeah, so there's always a buyer, for everything. It just depends on who your buyers are, what they're looking for. If I had someone come to me and he's like, look, I just want a straight cap. I got to dump some cash. I just need the highest cap rate you can find me in the valley right now. Give it to me. Great. Yeah, we'll give you a strip club. The other real risky ones right now that we're seeing on the market, and they're all high caps, are vape shops. If anyone owns the location, because with the new regulations, all the vape shops are getting shut down, right? Which is weird. You can have marijuana, you can't have it. So the vape shops are all getting shut down. So the same thing, we had an industrial property pop up, and it was this amazing cap. I want to say it was like pushing 9. It was probably a C-class industrial. We're like, man, this is so awesome. Like, yeah, let's do it. I got 5 investors right now. We can put an LOI. Sometimes we'll just shoot the LOI before we even have the investor sign because we just know it's done. And I'm like, we'll sell this like tomorrow. Anyway, we started digging through it, and if the tenants, a vape industrial tenant, they warehouse them and sell them, not locally, outside of everywhere, so they're getting shut down. So it doesn't matter if you have a 7-year lease, they're not going to be here in a year. So that's why it's knowing what's going on in the market, what's going on with the tenants, finding that stuff.
I got a question, I guess, in regards to you send LOIs and like compared to like, I guess, up to 4 units on a residential compared to a commercial side, is everything, I guess what I'm asking for is on like a 4 units because of residential right now. Would you have to do should you do an LOI on a 4 unit, or you just do an offer contract, I guess, for that compared to like a 5 unit or more, then would you switch over to an LOI?
So twofold. 1, 5 units and over, I would always do an LOI. Even if it's on MLS, I shoot the LOI. It's easier, it's faster, it saves time. Most of the brokers that are doing them are going to know what it is and how to work with it. I'll talk to them beforehand if I don't know the broker. We were working on one, and it was an office building north, like Cave Creek, but it was a residential agent. She had listed it for a friend, and we called her up. We're like, hey, look, like we've got a client's interested in it. Will you send us the stuff? And it's like, no, not without a confidentiality agreement. I'm like, it's $125,000. Like, we don't do confidentiality agreements on $15 million deals. Like, just send us the info. No, confidential. Okay, so we send her the confidential. Okay, we're interested. We'd like to send you an LOI. No, I don't do LOIs. You gotta send me an offer. Well, I don't want to send you an offer. I want to send you an LOI. Just see if we're in the same ballpark. So you'll have some run-ins like that might not work. On the flip side, so I always do LOIs. I think it's faster, it's easier. We have our boilerplate. We kind of run through them and make them simple. The other flip side of your question on 4 units and under, technically you should just do a purchase contract, but this is a conversation I actually just had on Monday with a bunch of agents in the Chandler office. Because your market's so fast and so crazy right now, I honestly don't see why you guys don't do LOIs on everything. Like, I would do an LOI on everything. Great, here's the property. Yeah, fast. You're not filling out 9 pages plus an AVA plus the market. But like I was saying, all your forms that make me like my stomach hurt. I'm like, oh my gosh, there's like 40 pages.
Because it is residential and because of all the landmines with disclosures and everything else, I just don't see that happening. Efficient, yes. However, it seems to me with all of the rules, not even regarding financing, but even in an odd way regarding discrimination and stuff like that. Oh, so how come you didn't you didn't act upon my LOI or something like that? It just seems to me that would
lead to problems. And I heard some of those complaints too, and I think you could address it in the LOI, and we're totally off topic here, and it's just me on my soapbox.
But like have boilerplate stuff in it?
And say, hey, we're gonna sign all these. We'll agree to sign the AVA and the homeowners, and we're gonna do all this stuff, and we're gonna make sure that all that's signed, but let's get to the brass tacks. We're gonna pay cash, we're gonna waive the appraisal, we're gonna do a 2-day inspection, whatever it is, just so they have your terms, they know what it is, they're not having to sift through the contracts and figure it out. That said though, yeah, it's residential, you're supposed to sign a contract and send it over. 5 units and up, I do an LOI every time. Every now and again we'll get an agent on the other side that's not done a lot of commercial, and they'll say, well, send me an offer, and we'll send them an LOI. I'm like, no, I need an offer. And I'm like, no, that's an offer. Signed, sealed, delivered. We'll sign a contract if you go with it. And I'm like, no, I need an offer. So, every once in a while you'll get a stick in the mud that's not willing to budge, and so you gotta kind of play by their rules of whatever they're doing.
I have one more question. I guess after everything gets accepted, How about soil testing? Do you guys do soil testing on the multifamily for apartments, like phase 1, phase 2 type stuff? or-
Depends on where it is, and it depends on who the lender is.
Okay.
So 99 times out of 100, if we're getting lending on the property, we're gonna have to do an environmental.
Okay.
Probably not soil testing unless there's reason to believe that there's an issue with it. Or if for some reason it was in some sort of floodplain, like sometimes you'll see like a big apartment complex and like, you know, there's a weird section of it that's not built on. And you're like, dude, we can totally go out there and put another 40 units. Like, this is huge. Well, then you find out that's floodplain, right? And so they haven't built there. And so the rest of the property's not, so they'll probably have you do soil testing on one like that. If it's my client and they're paying cash, I advise them, here's all the things you should do.
Yeah.
It's up to you what you want to do. And some of them are savvy enough, they can look at it and they just go, yeah, we're going to do this or we're not. Some of them, you know, they say, well, I want to be protected, what should I do? Well, then do it all. You know, we're going to do it all. But most of the time, the lender will dictate what's going to happen. A lot of times in commercial, even in multifamily, is that they'll require an updated ALTA. And so that can be a huge hurdle to go over, especially if you're trying to do something quick, because right now surveyors are like everyone else, they are slammed. And so trying to get an ALTA, a new ALTA done in, you know, even a month and a half would be like pulling teeth. And then that's also a heavy expense. I mean, you're looking bare minimum, $2,500, and that's if it's super and simple. But they can go up to 15 grand, you know, depending on what it is, where it is. We have had great success. If you do commercial deals, I would highly recommend Premier Title. Their title department, their legal department's in-house, and they're not underwritten by the big boys, you know, the First Americans and whatnot of the world. And so they're able to adjust their title policies. And we've had 2 in the last 6 months where they've said, no, we don't need an ALTA. We'll give you a different disclosure. We'll give you a different commitment, and they'll shift it. So they'll sit down with the clients and they'll custom tailor the title commitment to make sure that they're covered. So, but great questions, yeah, because it is stuff that you just don't know until you get into it, where you're at and what you're going to do. You know, like sewer scoping, I tell my clients, do it. You know, especially multifamily. If it's multifamily, scope the sewer. You don't know what's down there, how long it's been down there, what roots are in there. You don't know if it's going from cast iron to ceramic to city or vice versa. And the roof drains, especially if it's a 2, 3, 4 story unit, scope the roof drains because those get backed up and now you're flooding units. But that's one I sit really strong on that one, even more so than a phase 1. I'm like, dude, get the scope. It's going to cost you some money, but it's going to best insurance you can buy in those deals. And my feeling with phase 1s is if someone else bought it before, it was clean. You know, if this thing's changed hands even once, it already passed the litmus test. So I'm not going to worry about it unless something's changed on the property, which is then if you get into like the industrial or the C2, C3 commercial, and you know, someone was repairing cars in there, or someone had a chemical shop in there, even some medical. You know, we've had some where they're doing, you know, medical labs in a building, and you're like, oh, it should be fine. And you're like, well, maybe not. So let's get this one tested and just see. So it's kind of just feeling out the property and knowing what it does and how it works. And then you had a question, Andrew.
No, oddly enough, the same question about the LOI that he gave you was going to be my question as well on that.
Awesome.
I don't want to jump ahead with any of the other.
Hey, you know what? I'm trying to pull up an LOI, and I don't know why my screen's not sharing again. So yeah, ask me.
Oh, okay. Then we get further into the weeds here. Also, I'd like to know your thoughts on 4 or fewer units, as well as 5 or more, or any other lease stuff. Estoppel certs. Always. I mean, what happens if the tenants don't play?
Estoppels are one of my other things, kind of like my, the one I was saying for, let's see if I can just shut this down. There we go. Estoppel certificates are ones that I try never to budge on. I always want estoppels. Even 4 units, I'll ask for estoppels. The only reason being is you just never know what's been happening and who's been doing what. This is an example of one that we use pretty regularly for multifamily. But you always find out hidden secrets with it. I do it in my office deals. I do it in my inline retail deals.
If I may ask, from a standpoint, is it more work for you? People aren't, like, in my limited experience, aren't willing to just jump up and go like, oh, here's something cool for me to fill out. Do you find yourself as a buyer's agent or as a listing agent running around more to try to secure all available, all estoppels?
I would say it's equal on each side. Most brokers are they're all working together for the same goal, right? We want to get this thing over the finish line. That's one thing I find pretty refreshing in the commercial world. It's a small playground. I think the last numbers I saw was like 2,200 commercial brokers in the entire valley. You know, so it's a really, really small playground. So I cross paths with the same guys all the time. And I know one guy's going to be a pain in the ass, and I know another guy's going to be super cool to work with. And if it comes down to that, I'm going to work with a guy that's super cool to work with, right? And I've had the flip side too, where we've gone to offer on a property. It was an awesome property, triple net lease, long-term tenant, credit rated tenant. And we tried to get in, and we were a day late because they already had an LOI. And they're like, hey, look, we're probably signing off on this LOI, but it's you. We'll let you come see it with your client. Cool. We go see it. My client's like, I want it. I'll buy it right now. I'm like, what do we got to do to get in? He's like, well, are you telling me your guy's going to close? I was like, yeah. He's like, well, Aaron Dutcher tells me it's going to close. I know it's going to close. So we'll kick that one to the curb. You got it. So that relationship in our world is like premium. And that's what I always tell my guys. Like, it's a small sandbox. Don't burn any bridges. Let's all work together. So we're kind of all on the same goal. If you got a good broker on the other side, we're all trying to get it there. We'll work together on estoppels. Usually in my purchase contract, I'll say, well, twofold. One, most leases will require that the tenant provides an estoppel when it's given to them or they're in a breach. And so we're going to review the lease first and see if that's the case. Then we know we're good. If it's not, then we're going to say something in the contract about the estoppels that if we don't get them, we'll have all our regular contingencies, but we might have a separate one for estoppels, that if we don't get it within 10 days of closing or 15 days of closing, that we have the right to cancel. Because they can take time, right? You got to get the tenants, like you said, it's running around, you're following up with them, hey, we put this on your door, or we dropped this off, or we mailed this to you, we emailed it to you, where is it? So we'll extend that. So we might have a regular feasibility period in time, but we might have a separate one for estoppels that gives us a little more time if we need it. If it's something cut and dry where it's in the leases, we'll just do it regular during the same feasibility period, so we don't have to worry about it.
I am definitely coming from a limited and biased view because I come from that pool of licensees who, just like the examples that you give, what's an LOI? No, I need in my limited experience, what I found was there was some tooth pulling that had to be done to get the service.
Yeah, we did a big office building, and I mean, it was a good site. It was a $20 million deal down in Phoenix, and we had some high-end tenants in there, and the estoppels got to go through legal, and they got to get shipped back east or Midwest or California, and they have to review them, and then they'll always have changes because attorneys got to get paid, right? So they're going to find something's got to shift. So it takes a lot of time, but we had one in that building, and he was a local owner, but he was a heavy hitter commercial insurance broker. Like, I mean, these guys are doing hundreds of millions. And he was like, no, I'm just not going to do it. We're like, it's in your lease. You got to do it. Like, what's the big deal? And this guy, literally, it was one of those ones where I said it was the ego just getting in the way because he just wanted to. And so, literally, down to closing, we had pretty well assessed it, that we're in a no-risk situation, that, his lease was his lease, his insurance company, we could go after him, we were solid. So we weren't terribly worried about it, but we wanted it just to finish it off. We got it like the day before closing, because he was just being that guy. And so, yeah, you can get some that regardless will be that stick in the mud, and you're like, dude, just do it. But on the other hand, you can find out awesome information. You know, sometimes it's even things like deposits. They're like, oh no, we were on a move-in special. We only paid a $200 deposit. Where on the rent roll, it shows they've got a $1,200 deposit. And so you're like, oh my gosh, well, that changes the numbers. Or, oh yeah, this is our lease rate. And then they'll write a note. But Johnny promised that every July we could pay half a month, and we've been doing that for the last 3 years. And so you're like, you go back and you pull the rent, and you're like, sure as shit, every July they're paying half a month's rent, you know? And so it changes the numbers. And so then you got to look at the lease. Is it agreed to? Is it not? What's the new owner going to do? What's it not? What's the implied agreement now that this has happened for 3 years in a row? So you'll find out a million little details on the estoppels, and you'll find out grievances too. You know, they'll say, hey, how are the tenants? Oh, our tenants love us. We're the best product. We run this cleanest ship, da 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 da. And then you start getting the estoppels back, and they're like, oh my gosh, I'm so glad we're getting a new owner. These guys are the worst. They did this, they did that. They were supposed to fix this, and the guy came in for 2 minutes, and he slapped some glue on it and left. And so you find out about deferred maintenance. You find out about tenant issues. Or, you know, things that are substantiated by the landlord, like, oh yeah, you know, all of our tenants are good, but that guy, you know, in unit 101, dude, you should get him out as soon as you can. Like, he's a big pain in the butt. And then sure enough, you get his estoppel, and he's like, yeah, these guys, you know, they promised me this, and they promised me that, and they haven't done anything. You're like, you know, you start researching, you're like, yeah, you know, they didn't promise anything, and this guy's a pain. He's just trying to, you know, get something for nothing. So I am a stickler on estoppels. A gal in my office right now is doing a deal. It's only, it's an office building. It's only 4 tenants, and the broker on the other side, we're listing it. He's buying it, and he doesn't like the leases. And it's again, mom and pop. They didn't run it right, and I'm like, yeah, the leases suck. That's why it's selling at such a great cap, and it's basically below replacement value. So I don't care. Like, tell him to pound sand. The leases suck, and he's like, well, you got to get me updated leases. That's not our job now. It's going to be your job. But we'll give you estoppels, because he never asked for them, right? He didn't ask for them in the LOI. He didn't ask for them in the contract. It's like, look, we'll give you estoppels. We'll go get estoppels. Well, I don't see what the estoppels are going to do for me. Well, they're going to verify the leases, and you're going to have it in the tenant's writing, because as you can see, the landlord has to sign, the tenant has to sign. I have another one that I use for more of the commercial deals that is a notarized estoppel. So not only do they have to sign it and verify that the information's true, they have to go get it notarized as well. So that, you know, that really locks it in. So if something happened down the road, it's, hey, look, no, that's not what your lease is. Your lease is this, and you even signed an estoppel, notarized it. Like, this is a binding document. You're locked in here. So yeah, for that guy, I'm like, dude, just get the estoppels. No, they're not going to do anything. I think you just get the estoppels, your whole world changes. So I always push, get the estoppel. Back on that question on the LOI, this is kind of just one of my boilerplate multifamily ones. We basically just outline the property, you know, what it is, where it is, who the buyer is, who the seller is. We always put and or assigned as for the buyer. All contracts can be assigned anyway. We just put it in there. You'll want to watch the purchase contract though, because sometimes the seller or the other side will say that it can't be assigned without my permission. It doesn't have to be. If you agree to it in writing, it's not illegal, then now it has to be. But it doesn't have to be. I always kick that out. I don't need your permission to assign it to my other LLC. Like, we're just going to assign it and move it on. Purchase price, initial deposit, where we're going, who the title company is. Feasibility period is one of those things that's in commercial that's really different. 30 days is kind of our rocket speed for feasibility, which is basically your inspection period. That's your free time to look at everything. Look at the leases, look at the property, go through the finances, get all your questions answered. So normally we're 30 days. Every now and again, if it's a cut and dry commercial deal with a cash investor, we'll push that to 15. I've had 9 months for feasibility periods. Raw land that's getting rezoned, I'm 180 days every time. Not even a question. I want that 180 days because I got to see what my what my zoning's going to allow. So every deal's a little bit different. Multifamily's pretty solid at 45, depending on the number of units. If you've only got 5 units, hey, you could do it in 30 all day long. You could probably even do it in 20, if you need to for a chip to play in the negotiations. But you start getting me into 60, 70, 80 units, I got to review those leases and all the financials for that. No, you're giving me at least 45. I'm more likely 60.
At what point do you do? I'm not familiar with this. I've never done anything with even a mid-size complex, but I have in years past been living in apartments and are doing spot inspections on particular units. At what size do you stop looking or inspecting every unit?
We usually don't, unless it is like, if it's 8 units, yeah, we're gonna look at them all. That 16 unit one in Arcadia, we looked at them all. We just could, it made sense. You start getting into the 20, 24,
it gets impractical at that
yeah,
point. And you get a good bead on how they've kept up the units if you just take a selective.
And you can you can look at the rent roll too before you go in there. And so if you see one that's like constantly behind on its rent, yeah, I want to look at that one. If there's one that's been vacant for a long time, I want to look at that one. And then you'll pick a couple good ones. Hey, this guy's been consistent. Or if they've told you, hey, we've remodeled these 10 units. Okay, I want to look at a few of those. I want to look at a few of the unremodeled ones and get a vibe. But yeah, once you start passing 20, it just really, to do all those, especially even with an inspector that's got a crew of 3 or 4, and it's going to take time. And then you've got notices, you've got to coordinate with everyone, and then the cost gets increases exponentially as well for the more units you do. So yeah, that's kind of my cutoff zone, depending on what it is. But 16, yeah, we'll do all 16. But we did a 22 unit one in Mesa. We looked at like 6 or 7. We had a pretty good vibe. One of the tenants told us about the cat lady, so we wanted to look at that one. We're like, oh, yeah, the cat lady unit. Let's look at that one. See how that is. So
Everyone knows.
You ever get anything like on the commercial, the manufacturing, industrial side that throws you a curveball, like, oh, this is secret clearance or top secret, we can't let you in?
Oh yeah, there's some stuff, and even just patents. Some people that are doing R&D. There was one in Tucson. They were doing. They had military contracts, and they had some. It was like some crazy number. I can't remember. Billions of infrastructure built into this building. Like you went in there. I thought I was in a time machine. I was like, someone's gonna click a button. And we're either going to create the next nuclear holocaust or we're going back in time. Like something's happening here. But we had to get security clearance. They had to do background checks. My client wanted to see inside. He's like, no, I need.
None of you could bring in your phones or cameras, correct?
Nope. No phones, no cameras, nothing. There's a building in North Phoenix. You'd never even know it. You drive by it. You've probably all driven by it. No windows, all concrete. It looks fairly decent on the outside, but it's a NSA building, and they're, one of their monitoring systems where they listen to everything, and you can't get in it. I don't care what clearance you get, you're not getting in that building, no matter what. And so, yeah, there's some interesting stuff, there's some fun stuff, there's some weird stuff, just like residential, you walk in, you're like, okay, someone was murdered here, I'm gonna just turn around and leave right now, this doesn't feel right. So yeah, you get a little bit of it all.
1995, after the crash in the early 90s, I walked in to a house and there was blood splattered everywhere in the living room. It looked like after it was vacated, they murdered somebody. And the horrible thing was it smelled like blood.
Oh,
it's all like, there's a CERT program.
Yeah, right. Come clean this up. So yeah, the due diligence, always give yourself enough time to go through it and kind of bury it on the property. And that's a conversation I have with the other brokers all the time. We just did a redevelopment in Chandler, and we had think it was a 6-month DD on it, and they're like, why? And I was like, well, this is what we have to do, this is how your property's currently zoned, this is where we need to get it. And they knew no one else could get it rezoned for what they want. They actually even took another deal because they liked it better and it was shorter. But I told them, I was like, they're not gonna get it rezoned for medical use. Sure enough, they came back a month later like, yes, that group, we had to cancel that deal, they couldn't get it rezoned. And you guys, I was like, we already have initial approval, but it's gonna take the time. So you give me the time, we'll get it done. They gave us the time, we got it done. So, you know, tailoring it based on what the deal is. And then due diligence items, you know, this is pretty, like I said, boilerplate, unless there's something funky that I'm not, or that's different about the property, but I'm always looking for, you know, utilities. Give me your current Alta. Do they have a phase one? Even if their phase one was 10 years old, I don't care, because like I said, that's the litmus test. Like, someone else already did it and it was clear, this hasn't changed, let's just move on. You know, especially if it's a cash buyer. We don't need to do another phase one. It was good. Maintenance schedules, all of that stuff. Because a lot of this, it looks good on the surface, and then like I said, as you're digging through the expenses, you're digging through everything, through it, you'll find out nuances about the property. That also gives you a little bit of that renegotiation ability. So, you know, I might go in really strong, especially right now because the market is really strong. I mean, there's not much negotiating on where things are because someone else is willing to pay it right behind you. But we'll go in strong, but then let's say we go in there and then we find all those errors in the books and now it's dropped our cap. And then the other big one is deferred maintenance. You know, we can't see on top of the 3-story building, all of a sudden we do the inspection and we find out the whole roof's got to be replaced. You guys haven't kept up on your maintenance schedule. And that's one of the things we ask for. What's your maintenance schedule? What's been done? Do you have a reserve account? Which those have gone away. That used to be a big thing, and it used to be a negotiation factor of who gets to keep the reserve account. Kind of like when you sell a business, who gets the AR? Who's going to get the money at the end of the day for what's sitting aside? Pretty much no one runs a reserve account anymore. If you see it, always ask for it. You know, it should be the new buyers. But then that maintenance, that deferred maintenance, is a great way to renegotiate the price. We had one where they just hadn't painted the canopies for the covered parking for the units, and this one was like 22 units. So it had, you know, some fairly decent covered parking, but they hadn't painted it, and it was rusting, it was starting, you know, to break down, and it was just one of those things, you're not looking at the canopies on the covered parking when you're looking at the rest of the property. So as we did the inspection, and we went back to them, we're like, hey, property's great, we got to talk about the canopies. Oh, we knew that was going to come up. Okay, good. I'm glad you know about it. What are you going to give us for it? Because my guy wants, you know, I can't remember, X amount of dollars. I think it was like $8,000 off the purchase price. It isn't huge. I mean, that's pennies when you're talking about 22 units. And they were like, yeah, okay, we'll do it. You know, and so we dropped the price and got it done. But that's a great negotiation tactic, especially when you're having to go in at top dollar, to come back to them and say, look, I'm giving you top dollar. We didn't beat you up on price. We're going in at a good price, but the cap rate's shifted, and your, you know, deferred maintenance is X. So we need the price to be Y. And 9 times out of 10, you're going to get it. You know, most people don't want to walk away from the deal. You've already done the work. You've already gone through everything. We did have one in Mesa. It was, I want to say it was like 14 units, so it wasn't anything crazy, but it was one of those, it was 2 buildings, and we couldn't get the map to add up. We knew something was off. Well, we finally figured it out that they had 2 water meters, which is super, super rare, but it was an older property. Like, usually it's 1 water meter, because the water meters to get set by the city are super expensive, and that's why there's usually 1. So like, you'll get an industrial complex, there's 1 water meter, because they're just going to split it up. In multifamily, there's 1 water meter because they're going to split it up. So just like we were talking about the electric meters, you know, 5 or 10 grand, a little cheaper when you're doing it at the time. But a water meter to get set, it is now based on value of the property, almost like taxes. So for instance, we're doing a $1.1 million shell building purchase in South Gilbert. So it's only $1 million. Guess how much it is to set the water meter? $22,000.
Get the hell out of here.
No. So that's why.
That's insane.
It's insane. That's where the city makes their money on some of this stuff. So that's why you'll see 1 water meter almost everywhere you go. This whole building, I guarantee you, is on one water meter. They're like, nope, one water meter. And so, yeah, that's the one thing I always warn my clients about, that they're looking to build their own building or develop anything. It's like, all right, you know, if they haven't been down that road before, most have been down that road before.
But
it's
that's so outsized the price for the relative value of the property.
Yep, it's crazy. And they've gotten worse over time rather than better. You know, I'm sure when this one got set back in whatever it was, I think this was built in the 60s, you know, it was probably $3 or $4 grand, but that was a lot in the 60s, right? So, but now, I bet you if they wanted to set that same water meter on that property today, it'd probably be right about that 25 grand, set the water meter. So, anyway, this property had 2 water meters. And they only provided us bills for one. And again, there was one that was self-managed, and so they're like, oh yeah, we forgot about that other water meter. Well, you forgot about the other water meter, and that changed our cap by a whole point. And so I went back to the broker, I was like, dude, we came into this, and I think we were at a 7 at the time. I was like, now we're at a 6. My client's not gonna buy it. We bought this at a 7. You've got to adjust the price accordingly. I think it was like a $64,000 drop in price to change it back up to a 7 cap. And the first broker, most of these things have multiple brokers on my team. We always have multiple people on every deal. And so the first broker lost his mind. He's an old guy in Mesa. He's done a ton of deals. And he's one of those guys you're like, oh, this guy? And so he was just like, nope, the BS, then fine, cancel. I'll sell it tomorrow, blah, 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 blah. I was like, well, that's not how this game works, right? We bought it at a 7 cap. And sometimes, and this hasn't played out so much recently, but like 12, 15 years ago, you could buy it on a cap contract that said, I'm buying this at a 7 cap, and whatever that price is going to be once we go through the financials. Now, as we saw in the
Out of custom, it changed, or out of some kind of regulation?
no regulation, just out of custom. I call it, there's a lot of standard practices in commercial, and there was no regulation on it. It can lend to disagreements on what that is. Like we saw, like who counts what to get to the cap. And so the major one was, well, this is CapEx, it's not expense.
Right.
Well,
In the example you gave, Google if landscape maintenance is
Yeah.
CapEx. You will not find any generally accepted accounting principle that says that. I defer. I understand, but there is such a thing is isolating owner expenses that could never be considered.
yeah.
But
And
you know
so-
what? If it created that many fights, I get it. But I like the idea of we'll
Yeah.
buy it at 7.
We'll buy it at a 7. Whatever that looks like at the end of the day, that's the number we'll pay. And so it was basically that conversation. It was like, look, we bought it at a 7. We're now at a 6 and some change, whatever it was. Like, you got to drop it 64 grand. We just can't do it. So I called the other broker because the other one was losing his mind because he had another teammate. Literally, like, hung up the phone with him. I was like, well, I didn't like that answer. We're going to call this guy. And I called the next guy, and I was like, look, here's what happened. Here's what's going on. This is what we found out. You guys got 2 water meters. He's like, oh, my gosh, I can't believe that. I bet you Roger doesn't even know, like the guy who was selling it. He's like, oh, we'll get it figured out. You know what? Well, even if we have to meet somewhere in the middle, I was like, we don't want to meet in the middle. We bought it at a 7. So, and that's kind of the professional courtesy, like, hey, this is what we agreed to. So let's all play nice. And sure enough, it took a couple days, but they dropped the price, and we bought it at the right cap rate. So it's just going through that stuff, giving yourself enough time on the feasibility period, dig through it, see what it is. Closing dates will always vary, depending on where it needs to be. Sometimes we'll close it like right after the feasibility period. If we have financing, maybe we need another 30, 40, 60 days. The banks, if you're doing anything financing, the banks are going to dictate a lot of what's needed and what you do. They're going to want to see all the leases. They're going to want to see all the expenses. They're vetting the property as much as they're vetting the buyer. And that's another thing I tell my clients if it's someone new. Commercial almost works backwards. You almost have to identify the property first, and then see if it's going to work, and then make sure the buyer likes it, and then take it to the bank. So almost never do we have a pre-qual, because it depends on the property. I can't give you a pre-qual. I don't know what I'm dealing with. I don't even know the property.
May I ask two two questions because of what you're saying, because you say the banks. Do you have a preferred commercial mortgage broker?
I do. I have a number of them depending on what they're doing.
Some are better at multi-family.
Exactly, and some won't do it. Like if you want to go to one of the major banks, Wells Fargo, Chase, they're not going to touch multifamily. They're not going to loan on it. It's their policy. They don't do it. Chase won't do investments, period. So if you want to buy an inline retail building, and even if you're going to occupy 25% of it, it's not enough to tilt it. You have to be at 51% for them not to consider it an investment. Chase won't lend on it. So then it's knowing who does, who likes it. There's different lenders that have different appetites for different products. Like Alliance Bank in town loves medical. If I got a medical investor or I got a medical doctor trying to buy his own place, you're going to Alliance. They will give him the best rates, they'll give him the best deal, and they're going to close it super fast because they understand that market, they understand the doctors, so they have an appetite for it. Same thing on multifamily. We've got two guys that love multifamily. Most of my other banks won't touch it. SBA products, if it is owner occupied, Chase, without questions, the best there is. Basically, they can get in for nothing. There's zero cost. I mean, some of these loans that you'll see come through, because it's commercial, it's totally different. The regulations, it's always funny to me because we're doing these big deals and these, lots of moving parts and big price points, and our regulations are like this compared to residential. And I find it far less litigious than residential. Shoot, that time I flipped houses for like 3 years, oh my gosh, like every other month I was threatened to be sued. I've never been threatened to be sued in commercial, not once. And so I'm like, what in the world? Because there's just not the regulations. Like, the one that always blows people's minds is like fair housing. Doesn't apply to me.
Not at all.
Not one bit. It's not. There's no house. Doesn't apply.
Well, even at 5 or more, it
No,
stops applying.
doesn't apply. So they're like, oh, you need your fair housing, or you need your lead-based paint. You need no, doesn't apply to me. The thing that does apply to me, ADA, all the time. If my building's not ADA compliant, oh my gosh, we are in trouble, and they're going to come down on us like a ton of bricks. So yeah, ADA, I'm aware of ADA. You want to ask me ADA requirements? I'll tell you all day long. You want to ask me?
You're always looking for ramps instead of steps?
Yeah, ramps, wide hallways, where's the rails need to be. But you asked me about fair housing, I have no clue. I don't know.
On the financing, and I'm not asking you to speak for all banks, but I do know that not all investors have 100% or even 50%. It's kind of like a follow-up two-part question. Number one, what is the quote-unquote lowest down payment in a commercial investment type of property, or at least the range? Is it 25%? Is it 30%?
Owner OC, SBA, 10%. Anything other than that, it's pretty much all 20 and up.
20 up.
So multifamily though right now is 30 and up. So if you want to touch 5 units or more, I haven't found a lender in the last 4 or 5 years that'll do it for less than 30%. Now you can get some amazing rates. We had one guy, he bought this guy. I worked with this guy for 2 years. He was awesome. Loved him. He's from California, retired vet. Like we jived. We were cut from 2 different cloths. He's much older than I am, like double my age, but we just jived, right? And it was great to work. I talked to the guy all the time. Took me like a year and a half to buy him a property. We ended up buying him literally a slumlord property in South Tucson. I was like, Ron, do you know what this is? Like, we have looked at some really good stuff. Are you sure? He's like, oh, I love it. He's like, I can drive over from San Diego just really fast. I'm going to keep one of the units for myself. I'm going to be like the maintenance guy. And all, and like, he just like fell in love with it. It was like, literally, the first week he was there, he had someone OD. He had to call the cops, and a guy threatened to kill him. I was like, Ron, what are you doing? This is the dumbest thing I've ever heard. And he's like, oh, dude, it's great. Like, it's like an adventure every day. This guy like fought in the war. And he's an old vet. He's like, they can't fuck with me. I'm good. Like, okay, Ron, whatever. But he bought this property, and he did 33% down, which was a random number. He wanted 33% down, but his interest rate was 2.75 on multifamily POS South Tucson, and he, 32 units, and he, no prepayment penalty, which is super rare. Usually they have massive prepay penalties for the first 3 years, and sometimes they cascade off after that. It was amazing. I was like, dude, you got the best multifamily deal I've heard about in over a decade. Like, it was unreal. So every bank's a little different. Everyone's appetite's a little bit different, but multifamily, pretty standard 30%. Obviously, you can always put down more and it changes the numbers. The thing that I tell them to look at more than anything is their origination fees. Because, again, it's commercial. There is no limit on origination fees. There's no redisclosure. There's no, hey, the fee went up 10% and now you have to redisclose everything and I need you to go sign some more stuff. No, it's, here's my loan. Take it or leave it. And so, like we did one in Chandler, starting to confuse my numbers. I want to say it was 2 million, like just under 2.1. Literally, I called my client. I was like, because I tried to get him to my banks. He wanted to use this bank out of Utah that he felt he had a relationship with, and I think he did, but the bank was a nightmare the whole time. I did not like his lender, and I told him straight up, I was like, your lender is going to kill this deal. If anything's going to kill this deal, it's your lender. Like it's not working. We had to extend it twice. I basically had to promise, and the only reason it extended is because I know the broker on the other side, and I was like, I'm calling. He's like, don't you dare tell me you want an extension. I was like, dude, I need an extension. He's like, damn it, Aaron. He's like, because it was a REIT. REITs are the worst to buy from. They have their line in the sand, they have their time frames, and that's it. And so I even told my guy, I was like, they're not going to give you an extension. You're going to have to pay to play. You're going to have to go hard, and you're going to have to put more money down. I'm not going to tell them the bullet to shoot you with, or I'm not going to give them the bullet to shoot you with, but just know what's coming. And
Per diem, could they do something per diem?
they can do per diems, but he didn't have a timeline. These guys were just killing it. And they asked for stuff that was stupid. It was just a weird, wacky bank all the way around. Anyway, more to the point of the story was, at closing on less than 2.1, guess what his origination fees were? $89,000.
Wow.
Wow.
I was like, Gabe, you are getting raped. And he was like, no, it's good, man. This is great. We're getting it. I'm like, no, it's not great. Like, you should be maybe paying like 30. Like 30 I could see. But $89,000, you need to call your bank right now. That can't be right. I even called the title company. I was like, is this right? And the title was like, yeah, that's what they sent over. I've checked it twice. I was like, this is ridiculous.
4.5%.
And he was like, no, whatever song and dance they sold Gabe was like, this is the best deal ever. I'm like, dude, you want to throw money away, I'll take the other 40 grand. Like, throw it over here, I'll take it. Like, this is
swampland in
ridiculous.
Florida, right?
So yeah, lenders, and I always say, find a lender you jive with. You know, whoever, I talked with that client this morning I was telling you about, and one of the guys he talked to that I sent him, he's like, I didn't really like him, he's kind of prickly. I was like, okay, cool, I'll send you another one. Find the ones you like. Yeah, because there's plenty of them out there that do commercial loans, and like everyone's got their appetite. And there's some guys that just get it done. Like, I know my Hail Marys, like, I'm like, this person's never buying a property. Because we'll try and vet them, just like you guys ask your clients, like, hey, how much down payment do you have? Where's your pre-qual? What's your business? How much are you looking to put down? If someone calls me and they're like, hey, I want to get, into a property for like 5%, never going to happen. What do you have? What can we do? Anyway, so some of them are Hail Marys, and I'm like, this person, it's going to be a miracle if they buy a property. And so there's one broker I send them to, I'm like, look, you need to talk to this guy. It's not going to be pretty. He's going to be horrible to communicate with. He's not good at picking up his phone. And the fee's going to be high, but you're going to get a loan. Well, let me go see what I can. Then sure enough, they'll go talk to a couple other people and they're like, yeah, we can't do it. Okay, call this guy. And sure, every time, he gets it over the finish line every time that they pay for it. And I pay for it because I can never get him on the phone. I'm like, damn it. Dude, you got to pick up your phone more. So, yeah, it's just knowing what the deal is and where it goes. And I think that's the biggest thing about anything, even just multifamily in general. Like, an 8-unit doesn't function the same as a 20-unit. And a 20-unit doesn't function the same as a 60-unit. And even a 60-unit that's in Peoria is not the same as a 60 unit in Chandler, right? And you're looking for those floodplains, and you're looking for the Altas, and you're looking for the surveys. And so, you know, a lot of times I'll get people that call me up and they'll just say, hey Aaron, you know, I've got a client, can you just, you know, just shoot me an LOI? No, I can't. What's the deal? Well, you know, it's just a commercial deal. Well, what kind? Well, or my favorite is, I just need a lease for a commercial deal. Well, do you know why there's not one in AAR forms? Because every office in every building's different. They all have a million nuances to them that all get addressed in the lease. You might get a lease that's 8 pages. My longest lease so far is 120 pages. So you can have everything in between. So it's just knowing that as you go into them. Every deal's different. Look at it different. Address it different. Make sure you're covering your bases. Thanks for coming, guys. I know we went super long.
Yeah, you're fine. We had another one.
No, totally good. I understand. Thank you so much.
I never used it because it's late.
So,
It's fascinating stuff, isn't
Yeah,
it?
it's really
a couple quick questions. They were
Go for
giving
it.
him that low of a rate in an entity?
Mm-hmm.
Okay. And then, because I've owned a lot of multifamily before, but smaller ones up to 5. Back when I was buying, not now because the market's been crazy, but we were able to negotiate, okay, the banks would require 30, sometimes even 40% down, and we would do seller financing on that and come up with like low or maybe 5% out of pocket.
Nice.
Are people able to do any kind of deals like that anymore with seller financing some of the down payment?
I would say not in the last couple years, just
Yeah.
because it's like, why am I going to do that with you? I'll just sell it
Right.
to someone else, you know, tomorrow. That's not going to make me do that. It's still there on different deals. Like we just did an office building that's seller financed. We did a mixed-use retail building in Mesa that's seller financed. And we did another one. I can't remember what it is. So it still exists, and it's not a bad tool for commercial in general. It's just multifamily is so hot right now.
Right.
I mean, and I have to fall on my sword all the time because like 2018, I was like, it can't go up anymore. This is stupid. No one. I told all my agents, all my clients, don't invest in multifamily. It's dumb. It's hit the top. It's all going to go downhill. And now I'm like, oh my gosh, I gotta like fall on my sword with that. I could have doubled, tripled, quadrupled our money by now. So yeah, it's not something that people are foreign to the conversation. That's one thing in commercial that I think is how a lot of commercial was done for years, was just seller, because you couldn't get the financing.
Right.
Or that barrier to entry with the high down payments was hard to overcome. And so yeah, it's pretty common to talk seller financing. Whether or not they'll do it's just up to them and how much activity they're getting.
Yeah, and then I see a lot of properties going out there with like 4 cap rates, 4.7, things like that. Once you add in financing to it, I mean, you're getting, you
Yeah.
know, a lot of times you're breaking even. So it's like, why?
Yeah, you're breaking. You're not even, or you're native. You consider inflation.
Right.
Like, yeah. Now you're spending money to have this, which there's a whole other investment strategy for that, right? If I've got a high net worth individual that's making too much money, he wants a loser, right? He's like, give me something that sucks. Okay, I can do that. So there's those guys, that'll come looking for it, but generally they're not touching multifamily or anything else. But that's the thing that blows my mind right now. It's just how low the caps are and people are jumping off of it. And some of the ones that have pushed it that way are those REITs, but they have a whole different mentality. They have a whole different hold strategy. They're paying cash with their own cash. So yeah, they can go pay, they bought one in Chandler, like $428,000 a door, like 300 and something units. I was like, what in the hell? Like that cannot. And we went through, I was like, they're basically making like a 2.8 return. And I'm like, dude, they'd be better off putting their money anywhere else than there. But they're banking on the appreciation, and sometimes those REITs they need the losers to offset stuff because they're making too much money somewhere else. So I'm just like, it blows my mind.
When you say that, I mean, a question, because it's something that, once again, limited view, but I think it gets glossed over. There is some losses on accounting that aren't losses that make up for it. Depreciation, just as you said, looking at a gain that isn't realized until it's realized. So appreciation, which you're not putting in your pocket, but depreciation on the other side softened that 4% cap there, and that's the reason why we love real estate, right?
And that's where a lot of my investors, they'll look at that internal rate of return, you know, more than just the cap and the NOI. You know, we're doing full depreciation schedules in a lot of cases, because it makes a big difference. And that's why commercial is great, because it's built to roll over, right? And so for novice investors, they'll always ask, well, why are they selling? They've owned it for 5 years. They're at the end of their appreciation schedules. They've only got, depending on how they did it, they've got 5 to 7. You know, and that's usually where it is. And then they turn it, and then they turn it, and then they turn it. And that's what it's built up to do, to keep it flowing in the market. And so, you know, the fact that I'm worried about some of the legislation, I really don't think it'll get passed, and maybe that's just my rose-colored glasses, but where they're looking to get rid of the 1031 exchange and they're looking to get rid of the depreciation schedule or bump it out, commercial's just going to sit stagnant. And everyone's going to get their puzzle pieces in place, you know, real quick, and then they're going to go, all right, sit on it. We're going to now sit on, this is going to be estate holdings, and we're going to sit on it for 30 years, and then we'll deal with it. So we'll see what happens there.
I think that even mom and pop kind of people, lots of benefit from 1031s. That would, I don't care if it was a Republican or a Democrat that passed that, there would be some heads on some sticks there, I think.
Yeah, I can't see it getting passed because too many senators and
everybody.
Well, why is that loophole there? Because the rich people, the senators and the congressmen all own real estate. They built the loophole for themselves, right? I mean, why can you write off a racehorse? Because senators and congressmen own racehorses. Like, it's the dumbest thing in the world, right? So it would blow my mind if it got passed, but I mean, it is on the chopping block, so it worries me.
How are you guys finding most of your listings now?
I don't know if I can get this PowerPoint to pull back up, but CoStar. So MLS, I have some slides in there. I pulled it last night. So over 5 units in MLS, there's 16 listings. So yeah, and
it was 6 in Scottsdale.
yeah, so it's like
I
nothing.
don't know. Today.
CoStar, only CoStar, no LoopNet, no.
So LoopNet is our Zillow. So you know how accurate Zillow is. It's the same thing, and it's a lot. Again, because it's not regulated, it's a lot of bait and switch. So LoopNet's great if you have nothing else. You know, some of my agents that come in and they don't want to pay for the CoStar fees each month, I'm like, look, we'll help you if we're not here. Use LoopNet; it's better than nothing. And Crexy's another one that's come up that I find actually way better, and it's free for the vast majority part.
How's it spelled?
CREXI. That's a free one. They're phenomenal. You can actually get flyers right on there. They assign confidentiality agreements right on there. Like,
Listing leads are coming from those places?
so for listing leads, it's mostly my style is referral. I'm not a cold caller. I'm not a farmer. I like meeting people. I like meeting Carol, who knows a guy, and then we work on it, or you know, someone that knows someone else that refers me to him. So I build relationships. That's how I do mine. But interesting enough, I just met with an agent from the West Side who's done a little bit of commercial with us, and he's looking to now go expand his market. And I said, look, you can do it like me. This is how I did my relationship building of my market. Or it's a lot like residential. You pick an area that you're good at, and then you pick the genre that you're good at. Is it industrial? Is it office? Is it multifamily? And then CoStar is awesome because of those corporate veils, the LLCs and everything. It's hard to get that information, right? Who's the real owner? CoStar cuts all that out for us and gets to the direct owner. So we can pull a property, get the true owner information, and contact them. And so we can call them, email them, send them a letter, whatever it is. Hey, we've noticed you've owned your property for 5 years. It looks like the market's doing great. You know, the standard pitch of, you know, it's probably time to rotate it. We'd love to send you an analysis and tell you what we think we could sell it for, and help you in a 1031 exchange to rotate it into another property. And so it's a great tool that way. Even for tenants, it's fantastic. There's a whole brokerage in town, Cressa. All they do is, I call it poach tenants, because most tenants are represented. Most of them have a broker, not all, but most. And I've lost a couple to them, and I fault that on myself for not keeping the relationship strong enough where they weren't like, oh, Aaron's my broker. So it's my fault, but they'll go and same thing, if the leases get put into CoStar, which they don't all, but a lot do, they can see when the lease started, how long the term was, and if they're coming up. And anything under a year, they'll contact the tenant and be like, hey, Bob's Barber Shop, it's good to see that, you've had good success there. We see your lease is coming up. We offer a full tenant rep service. We'd love to look at your lease and see if we can help you with renegotiating your renewal. Or if it's time to expand, we have lots of properties we can take you out to and show. Or if it's, maybe it's the opposite. Maybe it's time to tidy up some space. You realize you've had too big of a footprint and you can do it in half the space, and we'd love to show you those properties. And don't worry about it, the landlord pays me, you don't have to pay me anything, I'm just here to be your rep. And I'll take care of you and make sure that everything goes smooth. Bada boom, bada bing, you've got yourself a new client. So this guy, I bring up the barbershop because he's done like 3 barber leases of all things. And so I'm like, dude, hone in, make that your niche, call every barber shop in the West Valley, find them, you Google map them, go in, pull the property, see when their leases are up, see if they want to buy a space, see if they want to expand a space, see if they want to downsize. I mean, there's a million ways to do it, and start, farming that way. So CoStar is the strongest tool for that, without question. It's not perfect by any means. It drives me nuts, and it's expensive. We get a deal through my home group because we have enough agents under the umbrella that give us a discount. But for our we have all of Arizona leasing and selling, which you can get, if you want to just do sales, you can get a cheaper one. If you want to do just leases, you can get a cheaper one. If you want just Maricopa County, you can get a cheaper one, but then you're really limited. We have listings all over the state, so we need the whole state. But for ours, it's $330 a month per agent.
Per agent?
Per agent.
It's very expensive.
Yeah. So, so especially guys getting into the game, they don't want to eat that cost right off the bat. But I tell them it's a tool in your tool belt. If I'm building a house, I want a full set of tools. So I know which tools I need and I'm going to pay for them. And this is the same thing. So they usually work up to it.
You mentioned a couple of times analysis in what we've been talking here on that account. At least as far as financials, you said something about Excel previously. Do you use Argus or Excel templates?
Mostly Excel templates. It's just stuff that I've either got over the years or built over the years. So we just have our own stuff that I share with my guys, and we basically rebuild every deal we do just to make sure it pencils right. And depending on the deal, I've got a different Excel sheet. All my stuff's Excel. So.
But if they ask for something like, if the buyer asks for something like the tax, advantages or consequences or whatever.
Most of the time I'll refer them out because again, most of the guys that are at that level, they've got so many moving parts that I can't even begin to understand what their tax implications are going to be. If I'm talking to last year I worked with 2 billionaires and a guy that was worth over 500 million. Like he literally, we're putting a deal in, and the other side was like, hey, we know we're way too early to get a commitment letter from the lender, but can you just show us a proof of funds that he has enough for the earnest money and the down payment that we'd probably be looking at this. And we were cash, and it was 35 million in Phoenix, and it wasn't 35 million. It was 17 million in Phoenix, and we were buying cash. I was like, yeah. And so I called my client. I was like, hey, Bill, not always, but they've got a seller that's a little bit edgy, and I've done deals with Bill before. And he's like, oh yeah, you know what? I don't have access to my Wells Fargo account right now. I'll just send you my E-Trade account. Okay. He sends me his day E-Trade account on a PDF. Shoots it over with the account scratched out. Guess how much was in his day trade account? 35 million. That's his day trade account. Some of his fluctuations, some of his different stocks had fluctuated $300,000 negative that day. I was like, oh my gosh, how do you stomach this, right? But he's in a whole different world.
Right.
So for me to tell him how his tax implications are going to work, it's impossible. He's got so many moving parts. So I don't even try and open up that liability thing. If it's a smaller, client, they're buying a $2 million inline retail and they want to, it's their first time out, because I've got one of those right now. Absolutely, I'll give you some basics without putting, some unrealistic expectations out there, and then I refer them out to the different tax guys if they don't have them. Most of them do, if they're, investing $2 million and they've got cash in the bank. Most of them have a tax guy, and it's like, hey, I'd love to tell you, I can tell you basic depreciation schedules, I can tell you the IRR on this, I can tell you what your debt service would look like. You want to know what your overall tax implications are going to be, you got to talk to your accountant, because I don't know what all your moving parts are. You've got a lot of stuff moving, so depreciation might be great for them, it might not. We had a Canadian client a couple years ago when Canada was still doing strong in their market, and he came down to buy a property, and he was under contract, and he literally called us, and we weren't in it long, we were only in it like a week, and he's like, guys, we gotta cancel. I was like, whoa, what changed? Is everything all right? Like, I'm thinking like life event, like I'm thinking like your wife died or something. Like, dude, what's wrong? He's like, dude, I just met with my accountant on this property. If I make another $100 in the U.S., my tax liability goes up 40-something%. He's like, so I'll lose money all the way across the border. He's like, I can't do it. I was like, no, we can't do it. That makes total sense. I get you. Like, he's like, literally, if I make another $100 in the U.S., I'm screwed. I'm like, okay,
Wow.
pull it out. So yeah, it's finding out what their need is. Well, any other questions I can answer for you guys? I know we went super long on this.
I got one last question. I mean, everything else that I've written down was covered. Just one last question, and once again, it's based on my limited knowledge. I told you about that one commercial property in the redevelopment zone that I listed. I co-listed it with a commercial agent back in Orange County. But he took off somewhere. He took off out of state on vacation, and I'm running it back in the day, like the major newspapers in stuff like that, the LA Times. I get a telephone call from a guy in San Francisco. Yeah, tell me what the cash on cash is. Okay, I have a degree in economics, but don't you have to define what cash you're talking about before I can explain to you what cash on cash is? Question being, what percentage are they talking about when they just say cash on cash?
It's usually much higher. Your cash on cash, so like if you're looking at around, like call it a 6 cap, if you're doing a cash on cash analysis, you're usually going to be pushing almost double that, like 11, 12. So we'll get some guys that'll be like, hey, my cash on this needs to be 8. Okay, that's doable. But they start coming in and they're like, oh, my cash on cash needs to be 15. I can't get you there in this market. It's not going to work. So there's some general ideas of structure on that, but overall, it's just a matter of finding out what they're playing with and what they're buying. But it's basically straight numbers, no NOI, just straight cash and straight cash return of what you're getting.
Understood, but that's like, help me out here. Somebody who is likes being spuriously accurate out to like 6 or 7 decimal points here. Wouldn't the IRR, wouldn't the NOI, wouldn't the cap rate, as long as you know how you defined your cap rate, help you out much more than the cash on cash?
Yeah. Cash on cash is just fast and easy, right? So you're exactly right. It's not fully accurate. It's not something we get asked a whole lot. Most of our investors and buyers are pretty savvy. So most of them are either NOI or IRR. So they're pushing that number. If I get a cash on cash question, 9 times out of 10 I go, okay, this guy's new, right? It's either that or I've got someone that's loose and fancy free, which I have one of those too. I've got an investor, he's in Gilbert. The guy makes great money, but he's a ready, shoot, aim kind of guy. So he doesn't want the full details. He just, what's my cash on cash? Okay, here it is. Okay, let's do that one. So he doesn't want to waste time. He doesn't want to get numbers. It's just his MO. But 9 times out of 10, if I'm getting that question, I'm like, okay, this guy's new. Let's, we'll handle it with kid gloves, which there's nothing wrong with that.
You have to start somewhere, right?
Yeah, you got to start somewhere. You just know what you're working with.
And you know what, I don't know if this is the last question, I don't know if this is, I don't know how you operate inside of here. for people who have a healthy interest in doing different kinds of transactions, are you totally opposed to co-listing or co-representing a buyer? Or do you always want referrals? How do you like working?
So we are super open, super flexible. One of the great things about my home group is they allow us that, because most commercial houses, they're horrible to work with. You gotta stay in your lane. I even get referrals from other brokers and other, like Cushman & Wakefield, CBRE, that'll call me to give me their deal because they're gonna make less at their other place, and they can't do it because they're an industrial tenant rep and they have a office buyer. Their brokerage won't let them get outside their lane. It's like, no, you're an
Interesting.
industrial tenant rep, that's what you do. You cannot go be an office buyer rep right now. So they'll send it to me and be like, hey, Dutch, I got this office buyer, I'm gonna, will you shoot me a referral? Yep, absolutely, we'll take care of it. My home group lets us do whatever, however, they kind of give me a free rein, so it's great. And so I'm super flexible. If it's something where someone has a great relationship with the client and wants to stay in it, absolutely. I'll just coach you through on the back end, make you look pretty, make sure all the paperwork's there, and then we put it over the finish line. If it's where, dude, I have no clue and I don't want to, sure, hand the whole thing off, we'll take it, we'll run with it, we'll make sure you get paid when it's all said and done as well.
For those who are all, I have no or very little clue, but I'm very interested in it. Is there a part where, like, let me look over your shoulder
yeah.
while
We're fully open, fully transparent. I'll share my forms with you, my deals with you, and you run with it. There was a gal here, she stumbled on an investor that wanted to do, they ended up doing like 4 different deals. I think total she did about $5 million in those 4 different deals, all various commercial products. The first one, and she knew, I never talked to the client, she did. The first deal we did 50-50 because it was a lot of explaining and hand-holding and going through it. The next deal was like 60-40, and then the next deal was like 90-10, like to her, the line showed her. And then the last one, I basically just looked over everything. I was like, oh, you don't even need to, like, I'll charge you a flat fee. I'm not going to take 10% of your deal. Like, you basically did this one. She had been through it enough, and they're all kind of the same. I was like, I'm not taking, even 10% of your deal. I think I charged her like $5 or $7 grand, and she was like, cool, we're good. And she was
Awesome.
off and running. So yeah, every kind of in-between thing you can think of, I'm open to it.
outstanding.
I'm gonna need your account.
Oh, beautiful. Thank you.